Good morning and welcome. My name is Cara Deanna. I'll be co-presenting today with my colleague Brian Walsh. We work in the Bureau of Financial Reporting within OSD. And this year for the fall conference, we wanted to choose one specific topic to focus on. And it's related to reporting changes that we need to make in order to account for and report on certain New York State contracts. And the specific contracts or agreements that we're looking to identify are leases, public-private or public-public partnership agreements, and subscription-based IT arrangements. I'm going to start the presentation. I see we have about 170 participants today, so I just wanted to gauge who we had out there listening in today. If everyone can see, I believe it's in your chat window, the hand raise function. If you could raise your hand for me if you are the CFO of your respected agency. Okay, I see a couple. Raise your hand if in the past year you've received correspondence from our Bureau in regard to GASB 87 leases or have taken training on this in the past. Okay, great. And then lastly, can you raise your hand if you just were looking at the fall conference list and you saw the title GASB and you were kind of just excited to sign on and take this class and learn more? Oh, good. We have a lot of GASB interested attendees. Great. So here's our agenda for today. We're going to first start off with going over the new reporting requirement. Where did this come from? Who's telling us that we need to make this change? And why must we comply? And by we, I mean all of New York State. I'm going to go through kind of a timeline of implementation. What have we completed so far on this project? Where are we now? And what is our plan for moving forward? Then after that, I'm going to pass the presentation over to Brian. He's going to provide more detail and define more specifically the types of contracts that we're looking for when we talk about leases, when we talk about public-private partnership agreements, when we talk about subscription-based IT arrangements. What do those definitions really mean? And then we're going to kind of finish this presentation off with this new requirement, what do we need from our agency staff? And why do we need help with this implementation? All right, so I'm going to start with the overview. Just wanted to start off for people who aren't familiar with our Bureau within OSC, the financial reporting part of our Bureau is made up of two major functions, the cash reporting unit, and they are responsible for monthly and annual financial reports that are reported on the cash basis. And then there's the GAAP reporting unit, and we provide financial reports on interim and year-end on a modified accrual and full accrual basis. So I just wanted to make it clear that these changes that would need to take place are only impacting the financial reports that are prepared in accordance with GAAP. And because it's a GAAP basis, who is telling us that we need to comply with these requirements? If you're not familiar with this institution, it's the GASB, the Governmental Accounting Standards Board. They are the accounting and reporting standard setting body for all state and local governments. They establish and work to improve financial accounting standards for us. So the reason we need to adopt these standards, two major reasons. One is just the purpose of the improvements of these standards are because they help to increase transparency of government activities to the financial statement users. And we also need to adopt these standards because every year we have an external audit performed on our financial statements. And in order to receive an unmodified audit opinion, these need to be adopted and implemented accurately. The direct result, if we don't receive an unmodified audit opinion or an unclean audit, this could result in lower bond ratings for the state, which in effect would increase the state's interest rates on debt issuances. So the result of an audit opinion is definitely a major factor to the fiscal and financial health of the state. And this is why it's crucial that we identify a complete population of these contracts within the state, and then we report on them accurately. So this is, I want to give you just a quick overview of the new accounting requirements, specifically what it entails. Current accounting standards for these type of arrangements are actually pretty simplistic. When lease payments are made or when payments made on a subscription are made, we just book an expenditure as soon as a liability to make that payment is incurred. So currently, it's really just an operating statement activity. The new requirement changes this, and now we're going to have to show a long-term liability on our balance sheet that shows what is owed for example, the full lease term, the full term of the subscription arrangement, or the full term of that partnership, public-private partnership agreement. And then in addition to that, we also are going to have to show an intangible right to use asset on our balance sheet. I also have on this slide implementation dates for these standards. For leases, we're going to have to start reporting on this for fiscal year end 3/31/2023. For public-private partnerships and subscription-based IT arrangements, we have 1 extra year to report on this. It is due fiscal year end 3/31/2024. So what does this mean for your agency? So for the most part, contract execution in New York State is decentralized. We do recognize that for many real property leases, that function is centralized with OGS's real estate management, but we also need to keep in mind that other sort of leasing arrangements or these other types of agreements are executed at the agency level. So that's why we need agency staff to really understand these requirements and help us to analyze the contracts that are specific to your agency. We need to first determine a complete population of contracts that meet these definitions. And then this isn't a one-time, this isn't just one thing we need to implement in 1 year. This is that is going to need to be changed or evaluated going forward every year for any new type of contracts entered into or any modifications to current existing contracts. So just to give you a picture of where we started with this, where we're at now, we sent out correspondence last September to agency financial officers or agency heads in order to identify the appropriate agency contacts that we should be working with each of your state agencies to help us with getting more information on the types of contracts. Our correspondence last year was specifically focused on leases. However, since then, we have received 2 more GASB standards related to those other types of agreements. So we decided we need to also start educating agencies on these type of agreements too, as the process for reviewing them and understanding them and analyzing them will be pretty much the same. So we sent the letters out. We also sent out, it was a template, if some of you remember, of please identify all your lease contracts, and we asked for you to fill out certain data elements that we needed to calculate our lease liability and lease asset in regard to the standard. And that information was due back, I believe, around June. Obviously, as we all know, a global pandemic hit our country in March, so things kind of slowed down a little bit. We did receive some responses from state agencies regarding their contract information. However, as we were reviewing them, we had concerns that maybe some of the information wasn't complete or that we just weren't getting anything at all from some certain agencies. So with with that, and with the pandemic hitting, the GASB actually extended the due date for this standard. It was originally needed to be implemented in 2021, and now, as you saw on the previous slide, it was 2023. So with that little bit more time that we were given, and based on the responses we initially received from the agencies, we decided to kind of take a step back and reevaluate our process, and really thought about what more information do we need to help provide agencies to get the complete population of contracts we need, and then to move forward with getting the data elements out of each contract we need to properly report on this. So this is kind of this fall conference, and then moving forward is kind of how we're going to use this platform to start giving more information and more training going forward on this. So we want to start with specifically giving you more information about the certain types of contracts that we need identified. And we thought the best approach was to get the population identified. And then once that's identified, let's move forward with capturing the data we need to accurately report. So with that said, I'm going to pass the presentation over to Brian so he can give some more information on the types of contracts that we are looking for.
Thank you so much, Kara. And I have to say my heart was warmed to see so many hands being raised when Kara asked who was just interested because they saw GASB. I'm an accounting nerd. I love this stuff. So it's nice to know that there's some other accounting nerds out there as well. So as Kara said, the first step is really going to be to identify all the contracts that are applicable to these three standards. And as Kara said, really, you know, between the response, these other standards coming out, and in consultation with our auditors, we really decided to sort of step back, reset, and also we've been really trying to work hard to make sure, because we realize this is a big lift for agencies to review all their contracts and agreements to identify these. We really want to try and make sure that this is as smooth as possible a process for everybody involved. So that's why, you know, as you go through and you review all of these, we want to take this opportunity to identify, you know, all the 87, the lease agreements, but also the public-private partnerships and the software agreements, otherwise known as SBITA. I also want to emphasize that this is just an overview and that there will be more in-depth training. So we definitely do not expect you guys to be able to know the definitions of a lease or public-private partnership or SBITA. After this, we will provide more training. We just sort of want to give you a high-level overview. Also, before we go into contracts, I want to let you guys know that really the Bureau of Financial Reporting, Kara and I, we're here to be guides and assistants to you. So really feel like you have an ally and you have support because this is going to be a difficult process, but you're not going through it alone. We're all in this together. And lastly, as we go through the different contracts, I want to emphasize that it's really incumbent on you to keep an open mind as you're hearing these different contracts, these different agreements, and you're hearing these different standards, and make sure you don't write off a contract too quickly as not applying, because the auditors are going to be looking at this pretty closely. And one of the key things that they're going to be looking for is to make sure you had an open mind and you just didn't go and grab all the contracts that say leases, but you really looked at the agreements. And then lastly, before we move on, I want to emphasize that we're obviously entering a new fiscal landscape post-COVID. Nobody really knows what it's going to look like, but you know, the prevalence of these different types of contracts may change going forward because there's some real cash benefits or cash flow benefits to these standards as opposed to buying property outright. Okay, so let's go to the next slide. All right, so our first standard is GASB 87, which is leases. And GASB defines a lease as a contract, e.g. an agreement between two or more parties that creates enforceable rights and obligations that conveys control of the right to use another entity's non-financial asset, the underlying asset, as specified in the contract for a period of time in an exchange or an exchange-like transaction. Sorry, I had to read the definition. I'm a big definitions nerd. Really, the substance of this definition is that, well, the substance of the definition, or the heart of the definition, is you have to look at the substance of the contract. As I said before, you can't simply flip through all of your contracts and just pull out what the leases are. You really need to look at each contract and evaluate it to determine if it meets this definition. And as we go through some of these and you delve into leases further, again, it's really getting to what is actually happening in the contract and not what the titles are in the contract. We also realize that there's some fairly extensive technical language. So first I want to point out when the GASB statement says contract, we're not, the word contract in New York State might have a technical meaning of a signed agreement over $50,000. Really, when we say contract, it's really any legally binding agreement. So in New York State, that could be a contract, that could be a purchase order, or that could be something less than a purchase order. Whenever there's legally and a legally enforceable right, the entity is non-financial asset. Again, typically speaking with leases, what we're talking about are tangible physical assets like property, plant, and equipment, not anything related to financial assets, which would be like debt or equity. And when we say exchange or exchange-like, for purposes of this conversation, we're really assuming that the rent is more than $1 a year or some very, low number like that. And again, really, as you're looking at this, make sure that you're keeping an open mind. And if we can go on to the next slide, we can see some examples of the different types of leases. So we definitely noticed when we received some templates back, reporting templates, I think there was a real temptation to view the only leases as real property leases for office space, land, etc. But it's really important to realize that leases can be a number of different asset groups. So it could be real property, equipment, copiers, fax machines, stamp machines, vehicles, and even something like servers. And this is going to get into the software agreements that we're going to mention later on. Sometimes you'll have a software agreement, but as part of that agreement, you have dedicated servers. In that case, the servers wouldn't be included under GASB 87. Again, printers, copiers, but you also have some other things that might not be as expected. Billboards that you're using to advertise various programs, radio towers. Again, it's important to emphasize, keep an open mind as you're going through to make sure that we include all possible property, plant, and equipment that should be included, all contracts and agreements that should be included under GASB 87. Some things that are not included are short-term leases of 12 months or less. It's very important to put an asterisk there and say, oftentimes you'll need to do an analysis of the lease agreement to be able to determine that it's 12 months or less. So you can't simply look at something and say that it's only 6 months. You really have to go in and determine what the lease term is, because there could be renewal options that would bring that over 12 months. Leases that transfer ownership are not included. And again, it is only for agreements that explicitly transfer ownership. If there's a lease agreement out there that allows the state to purchase the vehicle or the building for $1, even though it seems pretty obvious that the ownership would transfer, that would not be that. So even if there's at the end of the lease term, there's a purchase option for $1, that would not be considered a transfer of ownership, and it would be included under GASB 87. Leases that transfer ownership are only leases that automatically revert to the lessee regardless of any payments. Leases of intangible assets. So a lot of these would be like copyrights, patents, things that lack physical substance. Leases of biological assets, animals, timber, or trees, or things like that. I don't think that that's going to be a common scenario for most of the agencies. Leases of inventory and supply contracts. These are all going to be excluded from GASB 87. All right, moving on to the next slide. All right, so now we're going to talk about public-private partnerships. And it's important to start off here by stating that the government can be on either side of these transactions. And again, I know I'm repeating it a lot, but keep an open mind. We are pretty unsure how frequent these will be, but these could be large or small contracts. So a public-private and a public-public partnership agreement is an agreement in which a government, the transferor, contracts with an operator, which can be another government or a non-government entity, to provide public services by conveying control of the right to operate or use a non-financial asset, such as infrastructure or other capital asset, the underlying PPP asset, for a period of time in an exchange or exchange-like transaction. An availability payment arrangement is very similar. It's an agreement in which a government compensates an operator for services that may include designing, constructing, financing, maintaining, or operating an underlying non-financial asset for a period of time in an exchange or exchange-like transactions. APAs are considered financing transactions. Again, we're only looking right now for you guys to identify some of these as possibly existing, and we are going to be here to provide assistance to you as you go through and look at these. And again, these could be large, these could be highways, bridges, large infrastructure projects, but it could also be something as small as a wheelchair ramp or a wheelchair elevator at an agency's buildings. So it could be big or small. And the biggest difference between the PPP and the APA is really simply how the transferee or the operator is going to be reimbursed. And again, we'll be able to provide assistance through that. If we can move to the next slide. So as you're going through and you're identifying your PPPs and your APAs, and again, we're going to provide assistance for that. You may also come across service concession agreements, which are a type of PPP. But the biggest difference here is the operator collects and is compensated by fees from third parties. The transfer determines or has the ability to modify or approve the services. And the transfer is entitled to significant residual interest in the service utility of the underlying asset. So just sort of an example to help phrase or help conceptualize the service concession arrangement would be something like if a government owned a golf course, and the government decided to have a company come in and run that golf course. The people who paid to be members or paid to golf there, they would be those third parties that would pay the company who is operating them. But the transferor, the government, would have the ability to tell the company who's running the golf course, what services they wanted, or to modify how that golf course was going to be used within a certain with a certain degree of freedom. So again, I think for this one, it's fairly helpful to think of a golf course to help guide you through understanding the service concession arrangement. And again, if an SCA is identified as you're going through, then you should immediately apply proper accounting for that. And again, we'll provide some resources to each agency on what the proper accounting is for that. If we can go to the next slide. All right, so again, just to help conceptualize some different examples of public-private partnerships. The state enters into an agreement with the developer to design, build, operate the construction of a building to be leased for office space for a period of time. Or the state enters into an agreement with the developer to oversee, manage the construction of a building, and when completed, the building ownership transfers back to the state, or the state enters into an agreement with the building authority to design, construct, or operate a toll bridge. And again, each of these three examples, they could either be a triple P or an APA. The triple P, a public-private partnership, that is really defined, again, by how the transferee is going to be compensated. So in the example of a toll bridge, and again, the examples here are relatively large, but they could also be much smaller infrastructure or capital improvements. But in the case of a toll bridge, if the operator of the toll bridge is going to be compensated based off of percentages of the tolls, then the government who's contracting with the company, they really aren't taking on any financial risk. Most of the risk is going to transfer to the company operating the toll bridge. And if more people are using the toll bridge, they'll do better. If fewer people are using the toll bridge because of COVID, then they'll do poorer. Versus an APA would be a scenario where the company's operating a toll bridge. However, the government is obliged to pay them $1 million a month regardless of usage. So again, in that case, the risk, the financial risk stays with the government, and that would be considered an APA. I know I'm getting a little bit into the weeds, and I can be a little bit of a technical nerd, but again, we're here to help you, and we're going to provide guidance as you go through to identify these different types of agreements. Okay, next slide. All right, so again, we're not expecting agencies to make final determinations, but only to identify agreements that could meet the definition of a triple P or an APA. And again, as you're going through and you're initially identifying all these different agreements, it's better to cast a wider net than a narrower net. If an SCA is identified, you should start reporting into GASB 60 immediately. Again, BFR can be a resource if you need to, if you need training on how to implement GASB 60. And as you go through, definitely retain documentation of your GASB 87 contract evaluation. Sorry, as you go through and you're filling out a template to identify all your agreements, make sure you identify 87 lease agreements, also any agreements that would be subject to 94 or 96. All right, if we can move on to the next slide. All right, subscription-based IT arrangements, these are more straightforward. Again, a contract controls the right to use another party's service-based IT arrangement, information technology software, alone or in combination with tangible capital assets, the underlying IT assets as specified in the contract for a period of time in an exchange or exchange-like transaction. So really, these are things like licensing fees for Visio, Project, Microsoft Office. Any of these types of agreements would be something that would fall under subscription-based IT arrangement. And again, when we say a loan or in combination with tangible capital assets, as you're going through and you identify software licenses, definitely make sure you look to see if there are any underlying assets, servers, dark wires, anything like this, because that would have to be reported under GASB 87. All right, if we can go to the next slide. So again, yeah, hardware components and subscription-based components are separated, and they're going to have to require the allocation of cost between the server, the hardware under 87, and the software under 96. And again, agencies need to retain the documentation in the GASB 87 contract evaluation template to identify arrangements that are subject to GASB's 94 and 96. And with that, I will pass it back to Kara to talk about the agency roles.
Thanks, Brian. Let me go on to the next slide here. Okay, so we saw this slide at the beginning of our presentation. I wanted to bring it back at the end just to segue again and emphasize that we need agency involvement in this process. And it's because we need your mindset and your professional judgment. You are the experts in the contracts that you are executing. BFR can help, and we're willing to help and we want to help, but we need to kind of have this partnership together to get these identified and get the elements we need. So as an example of that, and again, as Brian said, this is kind of just an overview presentation. We will be planning on getting into more specifics in later trainings and guidance that we're going to give to you. But just an example of why we need agency involvement and we need that mindset. And this is our first example for determining a lease term. So in order to calculate a lease liability and our right to use asset or a lease receivable, if your state is a lessor in a contract, one of the factors in arriving at that number, that value, is we need to know the lease term. So if you're someone in your agency who is familiar with lease contracts, your mind might immediately initially think, oh, wow, this is easy. We just signed a contract, 5-year lease for office space. There's my lease term. Well, that is what the term is stated in your contract. It's not necessarily the GAAP definition of the lease term, and how to calculate that is much more complex. So as you can kind of see from the visual we have on the slide, the first step to determining your lease term is your non-cancelable lease period. And this is the time period in which neither the lessee or the lessor can cancel a lease. Then, once we have that period identified, we have to include the period of any renewal clauses in a lease term if the lessee is reasonably certain they will exercise that option. Once this is determined, then we go to number 3. Include periods after an optional termination date if the lessee is reasonably certain they're not going to exercise that option. And then once we determine that piece of the term, then we go to step 4. Include optional periods to extend or not to terminate the lease in which the exercise of this option is controlled by the lessor. So it's definitely more involved. And the first thing we need to do is we need to look extensively at these lease contracts to find these renewal and termination options. And then we have to do an assessment that needs to be made to determine if it's reasonably certain that these options will be exercised. Reasonably certain, the definition of that is it's a high threshold of probability that must be met to include optional lease payments in the measurement of lease assets and liabilities. So as agency staff, you will need to make this determination as the subject matter experts of these specific contracts. This is an assessment that Brian or I or the Bureau of Financial Reporting cannot perform because we are not as familiar with the history or relationship that your agency has with the other lessees or lessors, or we don't even have that full understanding of your agency operations. So again, agency staff involved in executing contracts are the subject matter experts in helping to make this determination. Below on this slide are a list of considerations that will help agencies to determine if executing these options are reasonably certain. So some things to determine or some things to assess is you can look at significant economic factors, significant economic disincentives, any cost of identifying another suitable underlying asset, what the condition of the asset is, if there's history of exercising options or extensions. These are different considerations you can make to say, are we going to exercise that renewal option? Or is it kind of certain in this situation, we probably may terminate this lease? So for some examples, you might have a lease for office space, a real property lease, and you know that you always enter into 2-year agreements with these leases and you always exercise the renewal options. So that's history of exercising options. So that's an identifiable factor that you could be reasonably certain that you will exercise those options. In addition to having that rationale and making those determinations, it is equally as important to ensure that that thought process is documented because we want to ensure that you've consistently considered all factors when you're evaluating leases. So again, as a resource that our unit is going to provide to agencies, we have a template out there available for everyone. When you're reviewing contracts and making these assessments, we have a document you can use to walk yourself through your thought process. And we recommend that all this information does get retained and held as backup just in case BFR reaches out for some information or our external auditors reach back out for information. So with that said, I'm going to pass it back to Brian. We're going to go over kind of next steps and resources that we at BFR have for you guys as agency staff.
Oh, actually, if we could just hop back for 1 second.
Sure.
Okay. I will say, and again, before I came to OSC as an auditor for a public accounting firm, definitely keep your documentation and really for anything that you put in this, it'd be reasonable for the auditor to say, the rent cost during the option period are 50% lower than the current market rates. It would be reasonable for an audit firm to ask for substantiation for that. So really make sure you do keep your documentation because as we say in the audit field, if it isn't documented, it isn't done. All right, so we can just go over back to the next slide. All right, so there's a lot of work to do. So really at the agency level, what we're going to have to ask you to do is to take a second, much more in-depth look at your contracts. And again, when we say contract, we really mean any legally enforceable agreement. So that could be a contract, a purchase order, or something less than a purchase order. And you're going to have to go through and identify leases, triple Ps, subitas, and then you're going to have to, after going through a series of steps, submit that information to OSC BFR. So then what we're going to have to do after that is we're going to have to review your agency's work and basically come to an agreement that you have done the work necessary to identify all of the agreements. Again, this is going to be, you know, I don't want to shy away from it. It is going to be a lot of work, but we really want to be collaborators with you, and really our auditors are expecting us to make sure, you know, when you go through work and the CFO says, yes, we have identified all these, that BFR gains comfort over that. Again, we're going to provide more in-depth training for that process going forward, but the 30,000 foot level, that's really what we're looking at doing. And again, can't emphasize enough, is if it's not documented, it isn't done. Also, every agency is going to need to develop, and again, BFR is going to work with agencies to develop internal processes to make sure any new contracts or agreements that are entered into after this initial agreement inventory, any new contracts or agreements are identified so that appropriate accounting can be done. From OSC's point of view, what Kara and I and many other members are working on right now is we're going to provide additional trainings to the agency, and we're also looking at creating what we're calling an inventory kit to help guide each of the agencies through the process, through the steps that are going to be required to make sure you identify all of those agreements. Next week, we'll be hosting a training specifically for CFOs of state agencies. So if you're a CFO, we really encourage you to come. We're going to go into some more depth. Or if, you know, and if you know and work with a CFO, maybe you can help encourage them to come to that training as well. OSC is currently exploring options for a software system that is going to ultimately collect the information that are gleaned from all of these agreements to properly do all our accounting and disclosure notes. And we're working very hard to update our website to make sure that you have all the resources and tools necessary. Again, this is really a partnership. I view it as a partnership between BFR and the state agencies. And so we really want to make sure that you guys have all the resources that you need. And at a future date, we're going to have another training once all the agreements are identified for the analysis of the contracts. Really right now, what we're looking for agencies to be doing going forward initially is really just identify all the agreements that your agency has that apply to these three standards. So with that, are there any questions?
So it looks like we have a couple questions in the chat. We had a question, would trials be included for equipment on site? To Nina, who asked that question, I think we're going to need a little bit more information from you. So I would actually suggest maybe reaching out to Brian and I separately, and we can discuss your situation in a little more detail.
I see a question here. If OSC is contracted to perform an audit of a public authority, would that be classified as a triple P? So that would not be classified as a triple P because there's no capital assets. There's that is a part of that agreement. So with triple P is really what you need. One of the things that you would need for triple P is you need to make sure that there's some tangible asset involved. All right. There's another question out there. We purchased, own, our copiers would still pay for usage, click charges on them. Would this fall into any of the categories discussed today? So in a scenario in which you own your copiers, and I'm assuming this click charge, if that was just for toner and for having someone be available to service your copier, because essentially all you're getting is inventory or supplies that you're using up, and a service that does not sound, in that scenario, does not sound like that would fall under any of these standards.
So another question, will SUNY, which is a decentralized as procurement, be reporting as one entity or individually by campus? So SUNY and CUNY colleges, they actually complete their own audited financial statements, which then they provide to us and we include them in ours. So you would have to talk to the individuals that prepare the CAFR or your financial statements for SUNY to see how they are working to incorporate the standard. And then there's another question about, for public benefit corporations, the same situation with SUNY is with public benefit corporations as well. They are component units to the state, but they prepare their own audited financials. So whoever prepares your financials at the PBC would be responsible for implementing this standard. We wouldn't be collecting information from PBCs. Someone asked about the slides, where those can be available. I believe there's a link to the slides on the same webpage where you registered for the class. If you can't find them, feel free to email us and we can send you copies. I think that's everything. If we missed a question and we catch it later, we will reach back out to you. Or if you have follow-up questions or anything additional that you think of after, please feel free to reach out to Brian or myself. Brian, if you don't have anything further, we'd just like to thank you guys for your participation, and hopefully maybe we'll see some of you at next week's class.
Yes, thank you for attending.